Yeah. Let's bring in economic strategist Frances Stacy, wealth manager at Scarlet Oak Financial. Welcome to the show, Frances.
Yes, good morning. Thank you.
Good morning. We heard Alicia. The Fed is navigating, trying to bring down inflation, which is still above their 2% target, while also boosting a sluggish job market. What do you see on the horizon if we do, and probably will, see another rate cut?
Yeah, I think that what they're going to do is they're going to take the dot plot from January. The dot plot is kind of an estimate of where they think rates are going to land. And that, the dot plot from September, that's an estimate of where they're going to land. So the dot plot in September sort of suggested another rate cut in October and then another one in the December meeting. So that's sort of what the market has priced in. And, a departure from that, like she said, not getting a rate cut will probably cause a sell-off. And I think that Powell historically tries to do things that move markets the least and creates the least volatility. So the least volatility today would be 25 basis points. We're cutting it to 375 to 4. And we aren't as data dependent because we don't have data. The thing I'm really looking to see is if he makes any comments about what he's doing with the balance sheet. They're currently reducing it, and whether he stops reducing the balance sheet, that would be big.
You know this as well as I do, Frances. American consumers in recent years have had to deal with record home prices, car prices, along with rising costs on everyday goods like groceries and just about everything else. What benefits and potential risks will a rate cut have on Main Street? Is there anything you think is being missed in this coverage of the economy?
Well, the rate cut will benefit Main Street. And so we live in this bifurcated economy where we have the upper, 40% that have assets and they benefit from inflation because those asset prices go up. But the lower 60% largely doesn't have assets. They live paycheck to paycheck, and they are paying extremely onerous interest rates everywhere, particularly credit cards. Credit cards have ridiculous interest rates, almost 30% in some cases. And so these rate cuts will help them. They are the consumer that is spending on this credit that's driving the consumerism that's driving the economy. So I think it would be beneficial for them and the overall economy to keep those guys afloat.
I want to ask you about Mexico's President Claudia Sheinbaum. She says she and President Trump agreed to extend a trade deadline, which was set to expire this week. How much have tariff concerns been an overhang for our economy?
Well, they've been an overhang. Interestingly, whether it was by design or not, the fact that the White House kind of keeps shifting the goalposts makes it almost impossible for us to calculate an outcome in the markets. And so that's actually lowered volatility because the markets don't want to price something in where they don't have actual numbers. And so as these, the trade deal's on, it's off, it's extended, it's this, it's that, markets have largely ignored a lot of this just because it is on an ever-shifting ground.
Yeah, we certainly see that every week when the markets close. I have less than a minute, but I want to ask you about a new CNBC survey. It finds that some in the finance industry are still concerned about, quote, multiple lurking dangers, including the lack of data from the shutdown, the AI bubble, still high inflation, and whether politics is now playing a role in the Fed's decision. Fran, how do you weigh that with stocks hitting another all-time high on Tuesday and again closing in the green last week?
Yeah, well, the reason that stocks are hitting new all-time highs regularly is because we have a record amount of liquidity in the system, and that the S&P 500 is very correlated, and that comes from extremely high government spending. Because we have so much liquidity in the system, the high M2 money stock, that's what's keeping the stock market elevated and keeping it where it's ignoring these risks. I think the lack of data makes it hard for markets to anticipate things, which means when the actual data does come through, we could have a violent repricing, and that's the biggest risk.
All right, Frances Stacy, thank you for breaking this down for us this morning.
Pleasure.